Well, thanks, Joe. I really appreciate you taking time to chat with me today. I think this is a really important topic. I'm sure you talk to a lot of financial advisors and real estate investors, and I'm sure you see a lot of folks, probably boomers, who maybe bought properties years ago, and maybe they're getting tired of managing it now. They're getting up there in years. I know boomers don't want to admit it, but they are. Or maybe they're stuck because they know if they sell now with what real estate has done in the past, that they're going to face really sizable capital gains taxes and depreciation recapture. So I think what Inland's talking about and some of the things that you're offering could really help a lot of these folks out. So I was hoping maybe you could just sort of jump into at first the basics. What is a 1031 exchange, and then we'll expand from there.
That sounds great, Kirk. I'm looking forward to hosting this meeting here with you, and glad to cover the tax code and different ways to kind of utilize the 1031 tax code.
Awesome. So I'll kind of I'll hand it over to you and maybe pepper you with a few questions here and there. But I really appreciate your information.
Sure, that sounds great. So good afternoon or good morning, everyone, depending on what time you're looking at this. So I'm Joe Kingsley, and I represent Inland Real Estate in the Southeast. So I work with financial advisors like Kirk in Georgia, Florida, Carolinas, Alabama, and Tennessee. And what we're going to discuss here today is the topic of 1031 exchanges and how you can use that tax code to defer all taxes at the time of a real estate sale. So here's the disclosure. So in order to invest in a 1031 exchange that's a security through a financial advisor like Kirk, investors do need to be accredited investors. So that means $1 million in net worth, not counting your primary residence, qualifies you as accredited. Or if you don't have $1 million in net worth, then 200,000 in income for a single filer for the last 2 years, or 300,000 on a joint tax return. So any of those criteria makes you an accredited investor. Little background on Inland. So we were founded back in 1968. And our four partners that started the company back then were actually four Chicago teachers in their early 20s that started buying real estate during their summer vacation time. So they raised some money from other teachers and bought some land in Chicago, built a house as far as their initial project went, sold that, had some success with it. They did that 3 more times. And then in 1968, they all quit their teaching jobs and formed Inland as an organization. So we have been around 55 years. Some of the milestones along the way are we did our first apartment complex deal in 1971. We did our first retail shopping center in 1974. In 1989, we became Walmart's largest landlord in the United States. So the company grew and grew. And then we started doing 1031 exchanges right about that same time in the early 90s. And that became a bigger and bigger part of our business. And then in 2001, we formed a division really just to focus on that tax strategy. That's called Inland Private Capital. That's our division that sponsors our tax advantaged real estate programs, including our 1031 exchanges. If you look at that division, we've done over 300 programs for investors, and the results are on this summary here. So that 8.5% return number is the average return for all of our programs that bought their properties, managed those properties for income, and then sold the properties at the end of the program. So that return is per year on average 8.5%. Usually about half of that return comes from the income that's paid out on a monthly frequency. And then the other part of the return would be capital appreciation that's realized at the end of the program once we sell the property. And our programs tend to last 5 to 10 years for investors. So along the way, they're getting their income on a monthly frequency. And then at the end, when we sell the property, that's when we distribute original investment value and any capital gain on the property itself, resulting in a gain. If you look at our results, we've really invested in all major sectors in real estate, retail, office, multifamily, industrial, student housing, healthcare properties, which could be either senior living, nursing homes, or medical office buildings. And then we also do self-storage as an asset class too. So we are one of the largest privately owned real estate companies in the United States today. And the tax code itself, if you look at the 1031 tax code, it's been around for 102 years. So it was written into law back in 1921 as a tax code by the IRS. And really the whole intent of it is to allow investors to defer all their taxes at the time of a sale of a real estate property, as long as they reinvest all proceeds into real estate. So it really was designed to promote real estate investing and encourage real estate investing. If you think of the environment we were in back then, we were in a recession back in 1921, and the IRS wanted to produce some tax codes that would spur the economy along. And they thought that by allowing investors to defer all their taxes when they sell real estate, as long as they buy an equal amount or more in real estate, that would spur the economy along. If you think of all the people that are related to a real estate transaction, there's numerous parties. So you have the investor, you might have a financial advisor like yourself, a CPA, an attorney, a title company, also construction companies involved in rehabilitation, improvements of property. So a real estate transaction filters all the way through the economy at a lot of different levels. And it's estimated that in 2021, the 1031 tax code contributed $95 billion to GDP in that year. So there's a lot of transactions associated with that sale and a lot of parties involved in a real estate sale. When the IRS wrote the tax code, what they stated was when you sell a property, in order to do a 1031 exchange, you need to purchase a property that's considered light kind in order to follow the rules of the 1031 tax code. Well, everything is light kind. So you can sell really any kind of property other than the house that you're living in as your primary residence, and turn around and invest in any other property type with those proceeds from the sale. So someone that sells, let's say, a rental home that they have, maybe they have a beach house or renting out on VRBO, they could sell that and take the proceeds and buy into any one of these property types. If someone has raw land, let's say that a developer comes in and purchases, they could take those proceeds and invest in any other sector of real estate. So that like kind definition is almost a misnomer because everything is considered like kind. The only thing you cannot do a 1031 exchange with is the proceeds from the sale of your primary residence, but everything else is really eligible. And as long as you reinvest all proceeds, then the whole transaction is tax deferred. There's two things that can cause taxes when you're doing a 1031. One would be if you take any cash out from the sale and don't replace that part into real estate. You can do that, but you just pay taxes on that part that you take out of the exchange. Also, if you sell a property that had a mortgage on it at the time of sale, then you do need to invest in a property that has equal or higher debt to equity as the property that you sold in order to avoid taxes. So, for example, let's say someone has a $200,000 mortgage on $1 million property and they sell it. What happens then is the bank will get paid back the 200,000, and that investor is left with 800,000 after the bank gets the rest of the mortgage value. That investor that had a $200,000 mortgage does need to take his 800,000 and invest in a property that's at least 20% debt to equity, because he had a $200,000 mortgage on $1 million property. You divide the 200 by $1 million to get to 20% debt to equity. So that investor would need to invest in a property or a program that's at least 20% leverage in order to avoid taxes.
Now it could be more, right? So if you wanted to move up to a $2 million place and have more debt, that's fine, but it has to be a minimum of what you had before.
Exactly right.
Okay.
Yep. So the IRS wants you to replace the whole value of the property that was sold, including the debt portion. So you can always go up in debt and buy more property. You just can't go down in debt and buy less property. So if you don't replace the whole value, then that amount of the debt that you don't replace would be taxable.
Okay.
So,
and I assume, like for the other one where you're talking about, if they do pull some cash out, then the tax rate is a prorated amount based on total gains and depreciation recapture, everything that along like that.
Okay. Yep. So when you don't replace the cash, and anytime you don't do a 1031 or you don't replace the cash, the first taxes that come due are depreciation recapture, which can be as high as 25%. Then you have federal capital gain of up to 20%. Depending on what state you're in, you may or may not have state capital gain. So Florida, obviously, no state capital gain. But if the property is held in another state, then there could be state capital gain tax liability. And then also the last tax is net investment income tax. That's 3.8% on anything above $250,000 in any sort of investment, including a real estate sale. So any cash that you don't replace gets taxed in that sequence, basically.
Okay.
Now, if you replace everything, the cash and the debt, then the whole transaction is tax deferred.
Okay.
At that point. So the timing is very important in a 1031. Number one, before you sell your property, you need to line an account up with a qualified intermediary. That's a firm that's set up to facilitate 1031 exchanges, and they basically hold your funds in escrow. So you can't sell a property, put the money in your checking account, and then go do a 1031 exchange. The money has to go to an intermediary first. Then once the money is held by that intermediary, then you have 45 days to identify replacement properties to purchase. So you actually write the addresses down on a form that the intermediary will provide to you. And if you're considering investing in an inland program, we'll provide you with the addresses of the properties in the program so that you can do that identification. So that all has to be done by the 45th day. You can always add property during the 45 days to the list, but once you get to the end of the 45 days, you cannot add any more properties to that list. So that's a critical day, the 45th day. And then by the 180th day, after you sold your property, you need to purchase some or all the property that you identified. So you don't need to buy all the properties that were identified, but in order to do the 1031 exchange, you need to buy at least one of those properties that you had on that list during the 45 days. Okay. And then the structure of our deals. So our programs are called Delaware Statutory Trust, and that's the entity that owns the property. It's a Delaware Statutory Trust, also known as a DST. DST started accepting 1031 exchange proceeds in 2004. So we actually worked with the IRS in 2003 to get them to consider amending their tax code to allow for DSTs as an option for 1031 exchangers. And the reason why we did that is this is a very investor-friendly structure. A DST can have up to 2,000 investors, so they're bigger programs. A DST can own more than one property also. So a lot of programs will have 2, 3, 4, 5 properties in there for diversification. And the investors just have to be accredited. So they just initial on the application, I am an accredited investor. And then the DST itself, there's no voting requirements for the investors. So any major decision that needs to be made is made by the manager of the program, not through a majority vote of investors or unanimous vote of investors. So it's the most prevalent structure today in the 1031 arena for people that are working with financial advisors like yourself.
Okay.
So the DST also gives the investor some protection from any liability that might happen at the property level. So a DST is an LLC by structure, and that LLC protects the investor from any liability that might happen at the property that's held within the program. So let's say a DST owns Publix grocery stores, and we have owned numerous Publix grocery stores in the past. Let's say someone goes into the grocery store and they slip and fall and have an accident in there. They can't hire an attorney and then sue the investor that owns that property through the DST structure. So there's never any liability for something that could happen in the property that would flow through to the investor. For that reason, they're never liable for anything more than their original investment in the
Okay.
program. So there is that protection. And then also DSTs will buy their property first and then open to investors. So you know exactly what's in each program. You pick and choose among the various programs based on your preferences with the property type, the tenant, the location, the sector of real estate. Also, the debt level is established at the onset. So you know how much leverage there is in the program and also the rate on the loan within the program prior to investing. So it is a very defined investment with the property already purchased. We don't raise money and then go buy the properties. The property is already purchased, and we're selling down our ownership stake in that property to the investors. So it is very transparent. So a couple things that come up quite a bit, especially in the Southeast. This one at the top here, vacation homes and second homes. So the general rule of thumb is if you own a vacation home or a second home, you need to rent those properties out for at least 2 weeks a year in the 2 years prior to selling the property for them to be eligible for a 1031 exchange. The other rule is you can't use the properties for personal use more than 10% of the time or 14 days, whichever is the higher number. 10% of the time it was rented or 14 days, whatever the higher number is. So for instance, if someone rents a property for 200 days a year, they could only use it for their own personal use 20 days in
Okay.
that same year.
Okay.
As long as you meet those criteria, then they're eligible. So it's a good idea if you own a vacation home or a second home, rent them out for a couple weeks a year, each year, because then they would be eligible when you go to sell them at some point to do a 1031 exchange. And what can be exchanged is the value of the building and the land that the building sits on. If there's any machinery or equipment in the property, let's say it's a farm and there's some farm equipment or something like that, that would not be eligible for the exchange, the equipment, just the value of the property itself. If you look at the profile at Inland of our sort of average investor, the average age is 64 years old. We've had about 500,000 investors in our programs. Average age is 64. It's a lot of people that are getting closer to retirement age that maybe are getting tired of managing their own properties and they want someone else to take that responsibility. So they'll sell their property, do a 1031 exchange, invest in one of our programs, and then they start getting monthly income right away from our programs. The initial rate is anywhere between about 3 and 5% starting out, and then it goes up over time too as the rents rise at the property level. So that investor will get that passive income. And then at any point in time, if they pass away while they own an interest in one of our programs, the heirs get a step up in cost basis. So it gets rid of all the old tax liability from the previous gain of the property that was deferred in the first place. So it's a nice way to leave the value of the property to the heirs without leaving them a big tax bill at the same time. So a lot of estate planners will use the 1031 tax code to solve for family ownership interests of real estate, where the family wants to divide the interest in the investment, but they don't want to divide the responsibility of managing the property too after the parents pass away. So
Okay.
you do get that step up in the event of the death of an original owner. The heirs receive the value of the investment without a tax bill at that point in time.
Okay. Now, are the heirs, are they still tied into the agreement that they had with the parents had with Inland?
They would be.
Okay.
So it's not liquid along the way for the investors. They do have to wait until we sell the property to receive their proceeds from the sale. If someone passes away, then the ownership interest would be transferred to the heirs, and then they would just wait until we sell the property to receive the sale proceeds. They would start getting the monthly income right away, though,
Okay.
from that investment.
Okay.
So again, the steps here are the investor sells their property to a third party, and then the money has to go to a qualified intermediary right away in order for that investor to be eligible. Once the money gets to the intermediary, you have the 45 days to identify, and then 180 days to make your investment. Once you decide what you're going to invest in, the intermediary will send a form to the investor called a release of funds authorization, and the investor signs that. Then the intermediary will send the funds to the closing of the next investment. So if it's coming to Inland, the money goes directly from the intermediary to Inland, and then we produce closing statements every day for our investors, and then that income starts accruing that same day that we receive the investment. And we pay our income the second Tuesday every month in all of our programs that are currently active. So this is really the heart of it here. Why do people do 1031 exchanges? It's really for the significant tax savings that you get by doing a 1031 exchange. So what we're showing here is an example of $1 million sale. And in this case, the investor paid his mortgage off, so there's no mortgage. And he originally paid $100,000 for this property. Over time, the investor's accountant has been depreciating the value of the property. So now the investor's cost basis is zero. So he's been fully depreciated. So if you don't do a 1031 exchange, the first taxes that come due are depreciation recapture. That's the difference between the price you paid for the property and its current cost basis. So that amount is shown here as 100,000 taxed at 25%. That's the depreciation recapture tax. So that would get paid if you don't do a 1031. Then the next tax is the capital gain from the profit on the sale. So the current capital gain rate is a max of 20%. So that 900,000 would get taxed at 20% if you don't do a 1031. So that's the big one. That's the biggest tax, is that 180,000 due to the IRS. Now this one you wouldn't have if the property's in Florida. Other states, it'll vary depending on the state tax liability. If you're in Florida or Tennessee in the Southeast, that's going to be zero. If you're in Georgia, North Carolina, Alabama, that's in the fives. And then South Carolina is in the sevens for state capital gain tax. If someone sells a property in California and moves to Florida, it's 13% in California.
Wow.
So some states have a very high capital gain tax liability. New York, New Jersey are in the 10 and 11% range also. So that can be a fairly large tax. If you don't do a 1031, you would be subject to that. And then the last one is net investment income tax. That's anything above 250,000. And once you hit that threshold, it's 3.8% on the full amount. So that's the last tax that kind of sneaks up on people in a lot of cases. They don't realize that's part of the equation until the CPA tells them, that's another
Yeah.
tax due. So altogether, if you don't do a 1031 exchange, you can lose about a third of your money pretty quickly to taxes. Now, if you do a 1031, you get to defer all those taxes. So you defer depreciation recapture, federal capital gain, state capital gain, and net investment income tax. All of that gets deferred, and you've got your full $1 million from the sale to go invest in other property with. So it's a very nice way to protect the value of that investment from taxes. Let's say you go into programs and you invest in DSTs that yield 4% initially. That investor will get $40,000 in passive income. They don't have to manage the property, they'll just get the monthly checks. And let's say that value over time in the property appreciates to $1.5 million or something like that after 7 years. That investor can do another 1031 exchange and just keep exchanging. And most investors that do 1031s are repeat investors that keep exchanging and keep deferring their taxes, and growing that account balance also over time. So at any point in time, if a property is sold, you can decide to take your money and pay your taxes, or you can do another 1031 exchange. And you can invest in something like this again, or you could choose to buy your own property. Maybe you want to buy a beach house or something like that. You can do that as well. Once a DST sells its properties, all options are open. So at that point, the money would just need to go to a qualified intermediary once we sell the property, and that makes that investor eligible again to do another 1031 exchange. So it can be a real nice way to just protect the value of that investment from taxes. And the income is also very tax favored. We're depreciating the value of the property in the program, and that shelters a large amount of the income from current taxes. So on average, about 2/3 of the income that our programs produce is sheltered by depreciation of the properties in the program, which means that part is not taxable currently for the investor. So if a program is yielding 4%, it really feels more like a 7% in a taxable equivalent yield comparison, because 2/3 of that 4% is generally not going to be taxable when it's received by the investor.
Okay.
So the income.
And everybody gets, I assume, a K1 every year from Inland.
Oh, so yeah, that's a great way to lead into this one. So it's a substitute 1099.
Okay.
1098 tax form. So
Okay, great.
it's a little less complicated than a
Yeah.
K1. What you'll see on there is the rent at the property level, the expenses at the property level. If there's a loan associated with the program, you'll see the loan interest accounted for. And then the last one will have the percentage of the investment that's allocated to the buildings and the land. You can depreciate buildings. So that part of the investment is what's depreciating over time. And the accountant takes this information from these forms and will put this on a Schedule E, part of a tax return. So if you own rental property, it's real similar to how you report taxes on a rental property. So you take the income that you receive from the property minus expenses, and then factor in your depreciation on a Schedule E, a part of a tax return. That's exactly what you do with this information. It all goes on a Schedule E, part of a tax return. And each year we'll do about 30 different DSTs. So we always have new ones opening. When we do fully subscribe an investment, then it's closed to new investors. But we typically will have 5 or 6 different ones open at any point in time. So if you're considering selling a property, we should have a number of options for you at any point in time. that you're looking to sell a property. So each year we do about $1 billion at Inland in programs like this. So about 30 a year has been our pace over the last few years. So it's never too early to, start considering options if you own real estate and you're thinking, eventually I want to sell it. I might want to leave the value to my heirs without a tax burden. Doing a 1031 does alleviate you from the management responsibility of the property. When you invest in a passive vehicle like a DST, you just get that passive income, don't have to manage your property anymore. And the goal of the program is also capital appreciation at the end of the day when we sell that property. And again, you could do another 1031 exchange if you choose to at that point in time.
Okay. And let's say you get to the end of the 5 or 10 year period where Inland's thinking of selling. What if we had a market like 06 through 08 and you actually had
Sure.
a decline? Do you continue it on, or do you guys kind of have a steady 10 years and we're going to move to the next project?
We'll hold on longer in a down market. So in our history, the shortest deals we've ever done have been 3 years long, which is an extreme example on the short side. That's because properties appreciated very high in a short period of time, and we decided to sell. Now, on the other side of that, if you get into a down market, those programs are going to last longer because we wait for the property to recover in value. If it's going down in value, we're going to wait until it's a better time to sell. So the longest programs we've ever done have been 12 years. So that would be an extreme example on the other side. And depending on the market, they tend to be 5 to 10 years on average. The ones that tend to be a little shorter are typically 1-year lease type properties, like an apartment complex, a community of rental homes, self-storage, student housing, senior living, nursing homes. Those have been a little shorter for us, anywhere from 3 to 7 years. The ones that are longer tend to be commercial long-term net lease properties, like an Amazon distribution center, for instance, with a 15 or 20-year lease, or a grocery store with a 15 or 20-year lease. Usually we're going to wait till about the 7th year to start looking at a potential sale of those properties. So if you're more interested in a shorter term potential investment, I would look more towards a 1-year lease type properties. And if you're comfortable with a longer term hold with a very secure tenant, like an Amazon or a Publix or Kroger or someone like that, those long term net lease programs tend to last 7 to 10 years for investors.
Okay. And how would investors kind of find out more about Inland and what you currently offer? Do you have any kind of, obviously a website, but anything else that might, educational materials, anything like that you can offer?
Yes, absolutely. So on our website, we do have all the educational materials, videos also from some of our chairmen of the company explaining the 1031 process. So we do have documents that you can download right from our website and videos that you can access anytime. So if you just Google Inland Investments, it comes right up. Our website will come right up. We're the only inland real estate firm. So that would be the correct one. If you just Google Inland Real Estate or Inland Investments, it does pop right up. And then I'm always available to, if you have a client that you'd like to do a conference call with, if someone watches this video and they want more information, you and I can always have a webinar like this for a specific client if they have questions in more detail. I'm always available for meetings like this on the internet or on the phone or even in person when I'm in your area too.
Okay. Great. And what are you sort of homesteaded at, Joe?
Oh, so I'm coming to you today from Atlanta, Georgia. So I live in Brookhaven, which is a suburb of Atlanta. So I cover the Southeast based in Atlanta, but I do travel to all the other states throughout the year. So major markets within the various states, including Florida, definitely travel to on a regular basis.
Okay, great. Well, thank you so much for your time today. This
Oh,
is
you're welcome.
again, I think this is something that I'm seeing a much bigger need for, especially boomers who maybe don't want to manage anymore. You also brought up something that kind of sparked an idea. I've got clients who that some of the kids are going to want to sell the property, some are going to want to hold. That's going to be a problem. This kind of alleviates that completely. And of course, getting that step up in cost basis upon their passing, and they don't have to manage it. That's just that's the cherry on top right there. So,
Right. Yeah, it can solve for a number of issues, including the division of the ownership of the investment itself, alleviating the owner from any management responsibility,
mhm.
and getting monthly income. So every month, the second Tuesday, we do pay distributions on all of our funds at the same time.
Okay, great. All right. Well, again, thanks, Joe. I really appreciate your time, and we'll be sure if I get any inquiries, I'll send them your way.
Sounds great, Kirk. I appreciate your time, and depending on when you're watching this, hope you have a great week or a great weekend. I guess
Yeah,
we're recording
absolutely.
this on a Friday, so hope you have a great weekend.
All right. Thanks, Joe.